What is going on YouTube? My name is RJ and this is the Gen Z Investor channel where my goal is to change the way investors invest. In this video, I am going to go through a PowerPoint and explain some fallacies that people make when they think that selling options is risky. So obviously the question today is selling options risky? Now, fallacy number one that people tend to bring up is that selling naked options is like picking up pennies in front of a steamroller. Now, the reality is that this cannot be further from the truth. The problem with this logic is that it overestimates the possible negative outcome of what I would say is a black swan event. So, a black swan, if you don't know, what I'm referring to is an unpredictable event that is beyond what is normally expected of a situation and has potentially severe consequences. Black swan events are characterized by their extreme rarity, their severe impact, and the practice of explaining widespread failure to predict them as simply fully in hindsight. So, how this refers to selling options is that people have a misconception that the likelihood of a company going bankrupt is significantly higher than the actual expected outcome of those events occurring. So the reality is that stock price movements will actually follow a normal distribution for the most part. And this means that having large standard deviation moves, you can actually assign a probability or a likelihood of those events occurring. So when it comes to a company going bankrupt, there obviously is a probability that would happen. However, that would be considered probably a 5, 6, or 7 standard deviation move to the downward, which that would only happen about 1 in a million chance, or whatever the probabilities work out to. However, the idea that this will happen to a company that you are selling a naked put on is statistically very, very unlikely. And furthermore, if you actually look at research, this is just one table or one graph that I found. So the reality is that returns or stock price movements will follow a normal distribution and will actually move slightly less than what is predicted. And what this means is that if you have a belief that the likelihood that a stock will move in a significant way, that belief is irrational because statistically it likely will not even happen. So I've got two questions. So first question for these skeptics is, how are you assigning probabilities of future price movements? Because until you can prove to me how you think stocks move and you can debunk the kind of random walk theory or the normal distribution of stock movements, there is no reason why you should believe that these large movements are going to happen when you jump into a naked put position. So this next question is more theoretical that I want people to kind of think about. So assuming you just bought a house, and when I refer to house, I'm trying to get you to think about kind of contrast it or compare it with buying a stock, or in this case, selling a put. So assuming you just bought a house, would anybody in their right mind think that tomorrow the house is going to be worth $0? And this is the main point that I want to bring up, because oftentimes you'll hear people say that selling naked puts is risky. However, in any other investment you have, whether it be stocks or real estate or bonds or whatever, you don't assume that tomorrow the investment that you made is going to be worth $0 or going to be worth significantly lower. Now, have significant moves to the downside occurred? Of course they have, but this idea that tomorrow a large large market cap company rather is going to fall to zero or to cut in half is statistically so unlikely. And again, you can assign probabilities to this occurring, but this question really highlights the, again, irrationalities that people have when it comes to the movements of stock pricing. So another fallacy that I want to bring up, or another example rather, is the airplane example, which I've brought this up in previous videos, but as we all know, there's a lot of people out there that are afraid of flying on planes because they think that they will essentially die. But so let me read this paragraph from Elite Daily, which basically says, the likelihood of dying in a plane crash or even in being in one is so slim it is almost pointless to quantify. According to The Economist, the probability of your plane going down is about 1 in 5.4 million. Others reports place the odds closer to 1 in 11 million. To put this in perspective, you are more likely to be struck by lightning or attacked by a shark than you are to die in a plane crash. Traveling by car is 100 times more deadly than hopping on a plane. Not to mention, statistically, it has never been safer to fly. So I bring up this example because stock price movements are essentially no different, and certain people's attitudes to selling naked options is a similar behavioral pattern as to some people who will not fly on planes because they fear death. However, there are numerous other behaviors that people kind of look past that are statistically more likely to kill you. Another point that people may make is they may say, well, if you would have been short a naked put on a stock like Enron during their whole scandal, you would have completely blown up your portfolio, which in that circumstance, yes, you would have been in a lot of trouble if you were short naked put in Enron. However, one thing that I want to mention is that when I sell options on companies, if they have any hint of fraud in the company, I will absolutely not trade naked puts on those underlyings. And if you'll see from this graph, there was fraud involved in the company in April 1998. And therefore, once I've seen a company that's had demonstrated any sort of fraud, I will not sell naked puts on that underlying because it's just not worth the risk. And in this scenario, I most likely would have not been involved in a company like Enron because they did have fraud before their major crash when they went from, $90 all the way down to zero in a very quick amount of time. So the solution to fallacy 1 is to realize that stock price movements follow a normal distribution. Additionally, the probabilities of the options that you sell being in the money are likely overstated. Again, only trade underlyings that are of the highest quality. Furthermore, if there's been any fraudulent activities within the management, then do not trade naked puts on those underlyings. Fallacy number 2. So this is a very common fallacy, and it actually takes a little bit to kind of understand, and it almost takes you have to experience being a trader and have occurrences in order to really understand this. So people may say you cannot possibly make risk-adjusted returns selling naked options because they should be efficiently priced. The problem with this argument is that it does not take into consideration all the moving parts of being an option seller. So as option sellers, we are going to be compensated slightly more than we should because we are limiting our potential upside. Furthermore, the way the amount of premium that options decay is non-linear. Therefore, we can exit our winning trades early at 50 to 65% of the credit received and extend our losing trades until they become profitable. This will increase our probability of profit. So what I mean by that is that if you sell a naked put that is one standard deviation below the current price, that has a probability of 84% chance of being in the money. However, we know that that is overstated, so you're getting compensated slightly more. So the reality is that once time passes, the likelihood of the realized volatility will actually be closer to 87 or 88%. Additionally, with closing trades early, that will decrease the probability of the option being in the money. Also, if you extend your losers, you can wait until they become profitable and wait for the stock to rally. So really, if you sell a put one standard deviation below where the stock is trading at that moment, the reality is that you can pull that 84% almost up to 100%, essentially. I mean, more like 99%. Because in 2019, I've probably made 100 options trades, and I currently have only had one position that is going against me and is in the money as of this moment. Every other trade that I have made, whether it was challenged or not, I ended up making it profitable. So that's really the difference between understanding why that you can become profitable in the options market, even though at that moment the option is efficiently priced. There is built-in strategies that you can have that will increase the probability of you making money. Additionally, the implied volatility of options are mean reverting, unlike stocks. So what do I mean by this? So most people who are involved in technical analysis will be familiar with these kind of graphs. So what these graphs pretty much tell you is that if there is a large standard deviation move to the upside, that's a sell signal. And if there's a large standard deviation move to the downside, then that is a buy signal, because stock prices will revert back to the mean. However, we know that stock price movements follow a normal distribution, and any large move to the down or upside is just a statistical probability, and it tells you nothing about where the stock price is going to move in the future. Comparing that with selling option premium, the way we are compensated is by the expected move or the volatility priced into the options that we're selling. And with volatility, it is mean reverting. So you know when it is high and when it is low. You know when it's essentially cheap and expensive. And the mean of the VIX index, which measures the implied volatility of, I believe, the S&P 500. So the implied volatility will be, the mean rather, is around 17 or 18. So anytime that the volatility is above that, you know that it is trading slightly expensive. And when it's below that, you know that it is trading slightly cheap. And you can use that advantage by selling more premium when the implied volatility increases and wait for a volatility contraction. So solution to fallacy number 2, realize that as option sellers, there are management strategies that allow traders to make risk-adjusted returns. Additionally, unlike buying stock, where you have no idea when to take profits, option sellers can have more of a mechanical approach that is more objective. What I mean by that is that you can close your trades between 50 and 65% of the credit received. However, when you buy and sell stock, you have no idea when a stock is under or overvalued, and you essentially don't have a very objective way to exit trades. Now, point number 2, option prices do have somewhat of built-in edge to them. They trade slightly expensive because you're taking on theoretically close to unlimited risk. However, we know that stock price movements are going to follow a normal distribution. So fallacy number 3. So because markets are random, using neutral strategies like strangles, straddles, iron condors will be less risky. The problem with this argument is that it does not factor in the volatility skew or put skew in the options market. So what volatility skew is basically the most simple way to understand this is that the put options will trade higher than the call options. So if you're selling a straddle if you're selling a strangle or an iron condor, the likelihood of the calls being challenged is slightly more likely. Additionally, it makes more sense to wait for stocks to correct, and when they have that volatility skew, and you can get more premium from the puts that you sell, because a lot of times in downward moves the puts will trade significantly for more premium, and you can collect more money. Neutral strategies will not maximize return for a given level of risk. It is actually far superior from a risk-return perspective to wait for market corrections and sell naked puts when they're trading rich. Furthermore, statistically, calls are more likely to be challenged, and even in large down moves, calls can increase in price due to heightened volatility, which is another reason why I don't like selling calls, because when markets correct, implied volatility goes up, and even if you are right directionally and you're short the market by selling calls, you can actually end up losing money because the implied volatility spikes so high that the calls actually get more expensive, even though directionally you were correct. So solution to fallacy number 3, realize the importance of volatility skew and how it plays into the price of the options you are selling. This will allow you to collect more premium and achieve a higher return for the given risk you're taking. Again, you do that by waiting for opportunities or corrections in underlyings and then selling naked puts when you identify those corrections, rather than selling both the call and the puts and just waiting for a volatility contraction. So conclusion, options are risky. There is no such thing as a free lunch, and if there was an easy way to make a ton of money, then everyone would be doing it. However, selling option premium will be the best instrument to use in order to maximize your portfolio Sharpe ratio, which is the risk reward ratio, which again is the whole goal of portfolio management. Lastly, anybody who tells you that trading naked options is too risky likely does not understand the statistics behind price movements in the stock market. So that has been my video on, is selling option premium risky? Thank you for watching. I hope that you can use these tips and go out and make more money on the stock market. Further, please share this video with anybody who says that selling option premium is too risky and they'd rather be a passive investor. Additionally, if you have any comments or concerns or don't understand any concepts in this video, please leave them down below and I'll be happy to answer those. Again, make sure to like this video, share it with other people who are skeptical or do not know anything about the options market, and subscribe to my channel for more content. Again, my name is RJ. This has been the Gen Z Investor channel, and I hope you have a wonderful rest of your day. Peace out.